The board won't hesitate to raise the cash rate further if there's a material upward revision to the outlook for inflation.
The world is inflicting price pressures on Australians, and we are doing the best we can to ease them.
It is Melbourne Cup Day next Tuesday when the RBA will decide whether to raise interest rates again. According to the inflation data for the third quarter of 2023 released by the Bureau of Statistics last week, although the year-over-year inflation rate decelerated from 6% in the second quarter to 5.4% in the third, indicating a slowdown, the quarter-over-quarter inflation rate accelerated from 0.8% in the second quarter to 1.2%. After 6 months, the big four banks are again on the same page, predicting that RBA will raise rates by 0.25% in November. If it happens, Australia may enter a period of economic stagnation or even a technical recession. Yesterday, Australian economists surprisingly predicted that housing prices will rise by 7% in 2024. Does this mean that 60% of our YouTube community might have predicted correctly? Will the central bank raise rates? And if so, what impact will this have on the Australian real estate market? Should you buy now or wait a little longer? Hey there, my name is Alex. Welcome to my channel where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. In the last video, I said the inflation was not as significant as expected because it fell from 6% in the second quarter to 5.4% in the third year-over-year. It was incomplete and incorrect, especially after reading more data from the ABS. That's why we need to discuss it again in depth. Let's get to the root of whether Australia's inflation has decreased or increased. Why do the big four banks all predict a rate hike? The ABS currently releases two sets of inflation data. One is the quarterly inflation, with the third quarter year-over-year inflation at 5.4%, meaning that prices in the third quarter of 2023 have risen by 5.4% compared to the same period in 2022, showing a downward trend for 3 consecutive quarters. Year-over-year inflations, excluding seasonal changes, are more stable and are lagging indicators. Meanwhile, the quarter-over-quarter inflation for the third quarter is 1.2%, meaning that the goods and services in the third quarter of this year are 1.2% more expensive than in the second quarter, with the second quarter's quarter-over-quarter inflation at 0.8%. Therefore, inflation is showing an accelerating trend in this aspect. Quarter-over-quarter inflations better reflect short-term market changes. The other set of data is monthly inflation, with September's year-over-year inflation at 5.6%, meaning prices in September this year are 5.6% more expensive than last September. This indicator has risen continuously over the past 3 months, showing an accelerating trend. The ABS currently does not compile month-over-month inflation data. We can see that in the more stable, slower reacting year-over-year data, Australia's inflation is showing a downward trend. However, both the short-term indicators of quarter-over-quarter and month-over-month inflation show clear signs of acceleration. This is one of the reasons why the big four banks quite unusually agreed that the Reserve Bank of Australia is likely to raise interest rates again on Tuesday, November the 7th, the day of the Melbourne Cup. Another reason lies in the domestic issues hidden beneath the inflation figures. That is, the cause of inflation is no longer just imported due to international factors, but more importantly, domestic reasons. Oil prices have skyrocketed in the last few months, driving up overall inflation in the third quarter. But with housing, retail, food, and particularly wage increases, Australia's inflation issue has shifted from external to internal. Last week's inflation data gave us 2 worrying signals, which perhaps only the central bankers could understand. This will determine whether to raise rates on November the 7th. The prices of domestic non-tradable goods and services, which are not affected by international factors and have no international competition, such as electricity, rent, local labor, restaurants, haircuts, etc., have risen significantly, with a quarter-over-quarter increase of 1.3% and a year-over-year increase of 6.2%. Those interested in economics can visit RBA's official website to read an article on this topic. Tradable goods and services which directly participate in international competition and are affected by global markets saw a quarter-over-quarter inflation rise of 0.7% and a year-over-year rise of 3.7% in the third quarter. The biggest driver here is fuel. So the data has confirmed our speculation that the global supply chain was affected during the pandemic, but now the market is gradually recovering and international goods and services prices are stabilizing. By contrast, domestic factors are the main reason for the current inflation rise. A series of domestic services have seen sharp price increases, such as pet services at 7.5%, restaurant dining at 6.1%, hairdressing at 6.7%, and financial services at 6.9%, insurance at 14.7%. From the history, service-based inflation generally lasts longer. The main reason is that the inflation rises, wages generally increase, which means that people's purchasing power increases as well. Thus, businesses have the reason and ability to continue rising prices. And of course, inflation will last longer. In July, the Fair Work Commission decided to provide a 5.75% wage increase to 2.4 million workers. The official statement is that even with wage increases, inflation increases, but we have not entered the wage inflation death spiral. That is, a situation where wage increases lead to price increases, which in turn lead to further wage increases. My view is completely opposite. If wages are adjusted upwards on a large scale again, it will be very obvious that we have entered this cycle. An economic downturn is almost guaranteed. If the RBA opts for a 0.25% rate hike on November the 7th, the official interest rate will rise from 4.1% to 4.35%. I'm sure the big four banks will rush to pass on the increased rates to borrowers. For someone with a loan of $500,000, this means an additional $76 per month. For the pandemic's low of 0.1% to 4.35%, borrowers' monthly repayments will increase by $1,292. So how many 500,000 loans do you have? If you have a $3 million loan, that's an extra $7,752 each month. For the average Australian, this kind of pressure is immense. So make sure to call your bank before November the 7th to try to lower your current interest rates. You may think that with such an increase in loan repayments and rents, people should be tightening their belts and saving money. Logically, yes, but the retail data for September says differently. Australia's retail sales in September far exceeded expectations, with a solid start to the spring shopping season. It indicates that inflation will remain high in the coming months. Data released by the ABS on Monday showed a 0.9% month-over-month increase in retail sales in September. This figure is far above the expected 0.3% growth and an acceleration from the previous month's 0.3%. The ABS stated that an unusually strong start to the Australian spring drove retail sales growth, and the release of the new iPhone also contributed to the overall sales boost. Where does the money for the spending come from? You guessed right, it's savings. First, since the pandemic, the government has been giving people money for free, but they choose not to spend it, accumulating substantial savings. Second, in the past few months, homeowners have refinanced and cashed out a significant amount. Third, wage increases have boosted people's spending power. These three factors combined continue to support people's spending habits. Who would want to lower their standard of living when they have money to spend? However, on a larger scale, people's spending power and willingness are gradually decreasing. This can be seen in the Australian stock market. The Australian ASX 200 index has fallen back to its 2007 levels, indicating that the last 16 years were in vain. Smart money is in the stock market. A country's stock market reflects its real wealth level more than any GDP or CPI numbers. The stock market's performance indicates that companies' current operation and future earnings are not good. Since people still have money to support consumption, increasing domestic inflationary pressure in Australia, when will their money run out? Some have conducted statistics and forecasts. The critical point is March 2024. If we put people in different categories by income, the 60% with the lowest income have almost exhausted their savings. If we expand to 80% of the population, their savings will run out by March 2024, while the top 20% will not face such an issue. If savings decrease to a critical level in March 2024 and consumption plummets, dragging down inflation, the full effect may only be evident by September 2024, after a lagging effect. Meanwhile, businesses will struggle, with layoffs increasing and unemployment rates rising. Only then will the central bank start considering stimulating the economy, that is, dropping the interest rates. So what about the question most concerning our channel's followers? What will the Australian housing market trend be like in 2024? I'm very curious about our channel followers' views on the Australian housing market in 2024, so I did a poll in our YouTube community. The question was, do you think Australian housing prices will rise or fall in 2024? As of the deadline for this video, 800 people have voted on our Chinese channel, with 60% believing that Australian housing prices will rise in 2024. 15 people voted on this English channel, with 73% betting on the rise. Interestingly, after seeing the inflation and retail data, renowned economists updated their forecasts for the Australian housing market in 2024, with an average expected increase of 7%. I don't know if these economists have surveyed like me or if they have some powerful forecasting models. Although economists' predictions are almost never accurate, it's very rare to see such unanimous forecasts from all economists. As of the deadline of this video, the housing market data for October has not been released. However, by the time you watch this video, I've already got the latest data. I guess the overall market will continue to rise. Specific analysis of the Australian housing market trends and predictions for the market trends in the coming months will all be shared in our monthly webinar this Saturday. For now, it is still in Chinese, and I will be putting on an English session at the beginning of next year. If you've made it this far, please give me a thumbs up, subscribe, and share this video with your friends. Turn on the notification bell to watch new weekly videos. And have a good one. Bye-bye.